Next is DCC, which is a company that I have talked about. It's in the BritBox. It's not done very well. That doesn't narrow it down very much because nearly everything in the BritBox has done relatively badly. It's down another 5%, or it was down another 5% this week. It's recovered itself a little bit. But as a quick overview, DCC is a kind of three-part conglomerate because it seems like a lot of FTSE 100 companies that they're interesting to me are three-part conglomerates. And if they're not, I redefine them such that they have three parts. But DCC has an energy division, a healthcare division, and a tech division, and roughly they all kind of do distribution. Some of them do some manufacturing as well. But energy involves marketing and distribution for things like LNG. Healthcare supplies, products and equipment, but it doesn't manufacture them. It kind of connects manufacturers to end markets. And the tech business is what describes itself as an enabler, which, as I understand it, is distributor for consumer electronics and AV equipment and stuff like that. Anyway, the point here is they've been trying to sell their healthcare and their tech divisions, and I looked at their market cap and what the analysts seem to think healthcare and tech were worth and thought, those two numbers are not very different from one another, and their balance sheet is in decent shape, so they said they will return pretty much all the proceeds they can make. And you were looking at around 1.3 billion for the healthcare thing and about 800 million for the tech thing. So 2.1 billion on a market cap of 4.75. That's quite a big dividend coming back. I think that de-risks your energy investment quite a lot. However, they have announced a deal to sell their healthcare thing. And they are going to sell their healthcare thing for not 1.3 billion, but we can call it 1.1, it's 1.05. The amount they're going to actually take away from this, once you get through the costs and stuff, is 945 million. It's a cash deal. So CF Dowlays, there isn't much of a danger of some other stock tanking and crushing this. 945 is pretty much accurately what they're likely to see from this. I don't expect that number to be materially different when we get to the final, everything settles. Part of that's deferred over a couple of years. About 15% of that maybe is deferred over a couple of years, but it's on its way. 20% of the market cap, which you might think, as I did, for something that was generating 15% of the operating income, 20% of the market cap's not a bad deal. Immediate arbitrage, but if you look at their enterprise value, this is after their stock has reset itself slightly lower. It's 15% of the enterprise value. So it's 15 for 15. And that makes it probably why the stock slipped a little bit, because they're thinking, okay, out goes part of the operating profit, in comes some cash. We'll give away 15 for 15 in terms of enterprise value. So it looks like that caused their stock to slightly re-rate downwards. But that kind of ignores, I think, one important point here, which is that healthcare operating income and revenues had been flat to down for a couple of years, and energy's been growing quite well. They've been pushing up sort of 9% numbers there. Whether they can do that definitely is another question, but I don't think operating income is all the same here. I think they've managed to cut away a decent 15% of the operating profits, a lousy 15% of the operating profits for 15% of their market cap in cash, which I don't much mind that. But it does lead me to a slightly different point here, which is that I think I'm seeing a trend just recently. And that trend is disappointing divestments. I saw WH Smith attempt to sell, they were trying to sell a dog in the form of their retail business. DCC's healthcare thing isn't a complete dog. It makes decent money, and they think in the hands of the right organisation. I've forgotten what it's the name of the thing they've sold it to, and it's not a very inspiring name. It could be a decent business, but they just don't think they have the right infrastructure to fit that into. Okay. But disappointing result from WH Smith, disappointing result from DCC. That, to me, Steve, tells me now is not a great time to be trying to sell businesses to other businesses. And I think that's good news on balance for both you and me, because we tend to like businesses that buy other businesses. And the constant worry, if you have those stocks in your portfolio, or at least not constant worry, but thing you ought to be aware of, is that if opportunities don't present themselves, companies tend to go reaching because whether it's Bunzl or Halma or Judges Scientific, all of these are looking for acquisition opportunities. And they're generally speaking, Bunzl's not, but they're mostly decentralized, which means that you're not going to get huge amounts in terms of synergy. It means that you need to pay the right multiple here because you're not going to get huge amounts of cost reductions. This might mean it's a decent time to be buying, Steve, and I think that might be a positive sign here. As DCC fell, I did keep adding into this because I think the 15% and bring it down slightly off operating income. It's a cheaper price for the energy business here, which I liked it at a slightly higher one. I like it more at a slightly lower one. So I'm a small addition here, but that's I think I'm now seeing a trend, basically, in terms of disappointing divestments coming through here, which is the wrong time to be selling this stuff, but the right time to be buying it potentially.
Yeah, I agree with that, Steve. 12 times full year adjusted operating profit for something is it's okay. It's not too bad. But I can add to your list of things that have likely been sold undervalued because Admiral has also sold its US business, Elephant, sold it to JC Flowers. And the deal says JC Flowers has agreed to pay approximately the net value of Elephant, and that to me sounds like they've received a fair a fair amount off the price. And again, that is it's kind of a subjective value because I think Elephant has only ever lost money for Admiral in America. And I seem to remember the last time you told me about it, it lost about 20 odd million for them, which is, Admiral's a decent sized business, but it doesn't really want to be going losing 20 million a year on its insurance business. So some Admiral investors, I guess, might be fairly happy to see the end of that. But yes, approximately the value of Elephant. So yeah, I don't know, Steve. I think this is a slow going. That's the problem with that. I think is that if you're trying to sell a business that's not really doing an awful lot, which is kind of the reason DCC want to get rid of this thing in the first place, it'd be very difficult to attract a decent multiple on it because it's not doing anything. So the fact that this is a cash deal is fairly attractive to me. I mean, if you look at how that Dowlais deal has gone for the BritBox, it's gone from saying, well, we'll make about 5 or 6% on this to we'll be lucky to lose only 15% on this deal, just because of how the market has reacted, how FX has happened, and this, that, and the other. It's going to end up being a pretty stodgy deal for the BritBox, and we've kind of committed to not really doing anything until things happen to us, or we reach sort of a 6-month period, and obviously in hindsight, reacting to it immediately would have been better. But yes, Steve, I agree with you largely. DCC, WH Smith, and now Admiral all selling units of their business for not quite the going rate. But yeah, I think it's largely in line with what you expected, though. This wasn't the biggest area of their business. A 13 to 15%, depending on which year you look at, of their total op profit. I think they'll be fairly happy to see the back of it, Stephen. If there's about 940 million or so coming back to shareholders, Steve, that's on the way to what you was expecting, no?
It's on the way to it, yeah, and I still think it's okay. It doesn't fill me with confidence for their plan to try and divest their tech division, which is the other bit that's kind of coming up. They're looking at sort of 2026 for that. So healthcare is, all things going well, a Q3 divestment this year, that's not bad speed wise for getting rid of that. Bear in mind it was announced sort of about 2 days ago. It's now Friday, April 25th. So shifting that by September would be reasonable, I think. So I think it's going okay. I think I'm wary that the share price slips a little bit when that happens, but when you get slightly less than you expect. But the energy business, I'll be interested to keep an eye on how that energy business is going, because if that keeps moving forward, that suddenly becomes worth the market cap by itself, even including the debt they have. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.